Welcome to the Mutiny Investing Podcast. I'm here with my partner, Jason Buck. We're going to be doing the first of a series today, talking about the Cockroach portfolio and the thinking that has gone into it. And this is something we're excited to start sharing and talking about. We've been working on it for the better part of a decade now. I started to publish some notes on our website, which you can find at mutinyfund.com/insights. And are going to be talking through some of what we've written there, as well as going into a bit more detail on this podcast. So today, we're going to start off with everyone's favorite asset class, stocks. Stonks. And talking about stocks for the long run, question mark, as opposed to stocks for the long run, declarative. So I'll kick us off and we'll go back and forth here. So many people are probably familiar. There's a very well-known book called Stocks for the Long Run by Jeremy Siegel. And I think broadly, when you look at how many portfolios are constructed today, stocks for the long run is sort of the core there. And I think there's a fairly straightforward logic that if you look at most sort of the large asset classes, let's call it stocks, bonds, gold, historical data sets, particularly historical data sets based in the US, tend to show stocks as the highest performing long-term asset. And so the logic goes, we want to have a portfolio that's mostly composed of stocks, especially if you're relatively young or you have a long time horizon, because of course you want the highest returning thing over a long period. And, I think that's sort of the basis in where people get to. And we want to talk about maybe a little bit more nuance around some of the thinking there. So a lot of this is based on, there was a great paper written by Anna Kolova et al. In the Journal of Financial Economics. You can go to our website and we'll link to that. Basically looking at developed market stock returns from 1841 to 2019. And what was interesting about this selection, this data set compared to what you typically hear, which is typically, I would say, in my experience, the most common thing is usually like US stocks, usually like 1920, 1929, something like that to present is typically sort of like the data set people quote from for stocks. And so I think the sort of couple things that jump out about the broader data set. One is the probability of loss over a 30-year horizon. So Jason knows the answer, but Jason, trivia, what is the, we could do a fun, like a fun Mr. Market or a beauty pageant. What do you think if I asked the average person the probability of a loss, losing money in absolute terms over a 30-year horizon with stocks? What do you think the average answer is? What does the median, reasonably intelligent investor that's read some investing books think?
I honestly think if you're going 30-year horizon, most people, it's going to be zero. People are going to think over a 30-year horizons, it's just up and to the right. You may have gone through a drawdown or a losing period, but I think over a 30-year horizon, I don't think anybody's going to think they have losses.
I think so. Yeah, I think it's 0 or 1%. I think it's incredibly low. So on US return data, that's actually pretty close to correct. The number is 1.2%. And that's real return, so loss in buying power over 30-year horizon. Across developed markets, 1841 to 2019, the number is a much higher, 12.1%. So call it roughly a 1 in 8 chance of a loss in purchasing, a decline in real terms of a stock-only portfolio, which I think I did a Twitter poll to this effect, and yes, the results were very different. That's not what most people would sort of like expect at that level.
Yeah, it reminds me of like Meb's Twitter polls. So I was just thinking I should text Meb and have him do a Twitter poll to see, like he would love one like that. But I feel like he's probably done one similarly. But also like with some of Meb's great papers, as you know, he's using global financial data, and I think like he has some pretty good heuristics in there. But maybe I should start with in your paper and stuff, we're talking about like real returns. And what are real returns? I mean, that's your nominal return minus inflation. And so that's what I think people, really care about your real returns, because you need, what can you eat after inflation? And I think rarely do even people look at real returns. So throughout this, we're talking about real returns, but I think Meb always has good heuristics too of the simplest way to think about it is, I think 6, 5, 4, 2, 1 is basically over the last 100 years, the US stock market has produced 6% real return. So once again, returns after inflation. The global stock markets have returned 5% real return after inflation. Just kind of shows you that American exceptionalism over the last 100 years. And once again, that's rear view mirror that we'll get to as well. Commodity trend following produces about 4% real returns. And similarly with bonds is 2% real returns, and then T-bills is 1% real returns. There's a little fudge factor. I think T-bills is actually like 0.78, but you get the general idea. It's like 6, 5, 4, 2, 1. So you get an idea of like the different asset classes and what they produce in real returns. But that's why it's important. Like we said, US is 6, but global stock markets, if we look globally, which you're writing about in this essay, it's a very different scenario. And, one of the luckiest things, if we were talking about our Peter Zeihan, I guess, thinking about, we have these great oceans on either side of us and all this, great growing cropland where we can feed ourselves. But especially if we look at Europe going through the world wars, they've had some dramatic drawdowns. And I don't know about you, I knew, we all hear about Weimar, going to zero, Russia going to zero, those sorts of things. But I don't know if Italy jumped out at you, man. They've been through hell and back. It looks like
negative 87% drawdown, 1928 to 1948, negative 84% drawdown, 1907 to 1927, negative 72% drawdown, 1960 to 1980. That's brutal. Argentina, we looked at sort of some of the worst scenarios across countries. Argentina didn't make that. I guess they're probably maybe not in the developed thing, but they also jumped out in real terms. I can't imagine. They must have had some. I would expect they'd have some sort of similar periods, but yeah, some brutal Italian periods in there.
And I think you bring up in the essay, talking about like Germany, Europe, and even like Japan, and we'll come back to Japan, but like you're saying in 1900, a priority, looking forward, everybody, if they were picking the best, economies in the 1900s that they thought were going to outcompete everybody, I think you put in there Germany and UK were like number 1, number 2. And even in the Western hemisphere, as we know, everybody's betting on Argentina. They would have picked Argentina over the US. And like you said, they're just not even there. They got wiped off the map multiple times with their stock market and currency. So it gives you an idea of like at least trying to place ourselves, in that time frame looking forward instead of placing ourselves, currently and looking backwards with that benefit of hindsight. But one of the other things I love that you did is one of my favorite phrases always is like everybody has all these great economic theories and how global macro works. And then you go, well, now do Japan. And Japan usually throws them all out the window. So talk a little bit about Japan a little bit too over the last few decades.
Yeah, so I mean, Japan it is sort of like the poster child case study for like, stock, country that I think it's interesting about Japan. Like Japan's really nice. Like I haven't spent a ton of time in Japan, but like it's not like it's a dump. It's like a really nice. The food's great. Everyone's really. It's like a very high function. Like the day-to-day experience is very high functioning there. From all the time I spent there, it's great. I love it. I actually wanted to go back. But they had this 30-year period, sort of 1989 to 2019, with negative 21% real returns. And that's not I think what's interesting about that is like, oh wow, that's so sort of uncommon. And that's actually that's in the 9th percentile of distribution, right? So that's a 1 out of 10 outcome, slightly worse, 1 out of 11 outcome. Like that's not insanely, you know what I mean? Like rolling I don't know, rolling 2 dice or something. Like this isn't like some crazy 1 out of 1,000 sort of outcome. Like that's in the 9th percentile of the distribution. So I think that's sort of one important point I wanted to stress here is just looking at global equity markets broadly, historically, and again, who can say going forward, but the sort of general confidence people have that over even a very long time period, like 30 years, that stocks are very likely to deliver a positive return. They're certainly likely to deliver a positive return. That's what the historical data suggests. Maybe not as likely as people are generally expecting. And I think, the other thing I wanted to talk about here that I think, we've talked about a bunch and is really interesting is like, okay, we could take these really extreme scenarios. Again, Japan's not that extreme of an scenario per se, but you could take these like, first percentile scenarios of of really unlikely things. But just looking at, I think I was Googling around, and that you often see like, oh, you Google what's the average return of stocks or something, something like that. And like typically the number I see getting thrown around in the media is like 7%-ish. That's like typically what gets quoted. And according to the data from this paper, that's actually like pretty close. That is pretty close to accurate. I don't think it was like 7.12 or something. 7% was like a reasonable estimate. But I think the interesting thing is, when you talk about average versus median, or average versus typical, right? So, I'll bring up my favorite ergodicity topic here, right? But the fun ergodicity example is if you're playing a game of Russian roulette and you have 6 people play one time, or one person plays 6 times. The 6 people that play one time, 5 win and 1 loses. The one person that plays 6 times is guaranteed to lose eventually, right? Eventually they pull the trigger and the bullet's in the chamber. So as one individual living one life through time, you do not get the average returns of the markets. You get what you get. You get whatever happened on that sort of path you are on. So that the median, the 50th percentile return is substantially lower. It's like a little less than 5%, 4.91%, which is not, I think you said, MEB's number was 6% US, and the US is sort of outperformed, right? So globally, it's going to be a little bit lower. That's not crazy. But then I think what's really interesting is the 25th percentile is a CAGR of 2.02%, so a compound growth rate of 2.02%, which over a 30-year time horizon is an 82% return, right? So you're, let's say you're 35 years old, you're 40 years old, you're retiring at 70. Take whatever's, if you have a sort of stock flying, the 25th percentile outcome is an 82% increase in real terms. And I think that's the one that I think if you surveyed people would be really surprising.
It was surprising to me. Like we worked on this for 10 years, and even when I was reading, I was like, Jesus, like that. Yeah. Like a 75th percent. I mean, that's crazy.
25th percentile. Yeah. I mean, right. I think it is surprising to people. And again, like I'll read some of the stats out here. The 75th percentile is an 800% return. It's great, amazing over 30 years. And that's actually pretty close to the average, the 75th percentile that says 7.6% CAGR. And I think I said the average was something, I think it's something like 7.2%. But again, you don't necessarily get the average. You get what you get over sort of the trajectory of where you live on. So I think one implication people talk about this, we talk about specific countries, is sort of global equity diversification, right? And I think that is a strong argument for that sort of approach. But I think it also sort of raises this question of like, if you're setting reasonable expectations, right? Like I think, planning for a 25th percentile scenario is not like disaster planning, right? We're not talking about like some highly unlikely wild scenario. Like we're talking about, like flipping a coin and getting heads twice in a row, right? Like that's the probability of this outcome.
And there's other things in there. I think that, like you said, if you run surveys, people say like a 7-8% return. What I actually think is more interesting that is if you actually, a lot of the other like kind of surveys, people just talk about the actual just arithmetic return, just what the annual return is. Like they expect 10 to 12%. I mean, usually you hear 10 a lot. I think people maybe just get fixated on like round numbers like 10, but it was either Meb or like Jared Dillian or somebody. They ran a survey of hundreds of people, and it was up to like 12% was the expected return. But like you said, like I think people a lot of times are just thinking about what the annual return is, and they're not thinking about the compounded return. And like when we get into this ergodicity, right, the simplest way to think about it is it's not addition, it's multiplication, right? You have to multiply your returns. And that's how that volatility drag, which we'll always get into, is like it's reducing that compounding. So if people are even saying 10 to 12%, like nominal return, like you're saying on the compounding, that's more like 7-8%. After inflation, you're talking like 5-6%, depending on what the inflation environment is over those decades that you're using. And then the other thing I want to be clear about is like, we're not anti-patriotic in any way. Like we hope America shoots the lights out for the next 100 years. It's just like looking at a historical representation. It's like, you can't be so certain of that, a priori. And one of the ones I always think is interesting that we like to bring up is like, people show 100-year, back test of U.S. stocks, and it's that up and to the right. And once again, they're not looking at those individual decades or their life cycle. But it's also, I like to bring up, since the advent of like the Industrial Revolution, let's say the mid to late 1800s to now, we went from 1 billion people in the workforce to roughly 6 billion people in the workforce, right? That's really unprecedented in world history. And, depending on which statistics you look at, we're supposed to have peak population of 9 billion. So the idea that you're going to, have a 5-6-fold increase in the working population is unlikely, and how much that affects GDP. And then America's ability to kind of hoover up global GDP is kind of unprecedented as well. So it's an interesting way of looking at it. Does that mean we're calling for the demise of America or American stock market? Absolutely not. It's just this is the way we try to think about these things with perspective. What I thought was interesting recently is, they're putting out, RIP Charlie Munger. They're putting out the newest version of Charlie Munger's Almanac, a revised version. Stripe Press is putting that out. And on Invest Like the Best, they had John Collison doing an interview with Charlie. I think it was just a few weeks before he passed. And what was interesting is, Buffett's known for recommending, just indexing, but Munger brought up exactly what we're talking about. He's like, this last 100 years of American exceptionalism is pretty unprecedented. And if you're betting on just a broad index of stocks for the next 100 years, he's like, he didn't think that was a very good idea. And so just another representation of that. But as we look at these 30-year periods and like, okay, what's the grand takeaway kind of, right? Like, what was like the lessons learned, like kind of like the end of the essay? Like, what were you thinking about, like using these 160 years of developed world example in these 30-year cohorts, maybe a 2% chance of losing money? What does that work out to? Like, what's the real takeaway?
So I think a couple things. One, also there's a section in the essay that people can go read. It also sort of looks at, if you started the time sample at different, I think they did like 4 different periods, and you get roughly similar results, right? So it seems fairly robust. And then, yeah, as you said, I think one thing that's like, it feels very obvious to people or somewhat intuitive to people that deal with markets a lot or interact with markets a lot is like, it's sort of like what's priced in or whatever. So this is a tangent, but like I'm reading Making of the Atomic Bomb by Richard Rotrow, which is great. I would recommend sort of like a history of the atomic bomb and history of physics. But like America was like, I don't know, my reading, it's like a bit of a backwater in 1900, right? Like it's not, I think we like take for granted America, the superpower or whatever, but like, my guess is I don't have anything to substantiate this, right? But like if you did the equivalent of a Twitter poll in 1900 of like which country is going to be the most successful over the next century, like I don't think America does great. It doesn't do terrible in that poll, but like I don't think it's number one. And I think that's part of, that's perhaps part of why it did well, right? Like it was underpriced in a certain sense that it outperformed, and so it would make sense that the returns were better. But I think in terms of takeaways, I think the biggest thing is just like, I think, sort of looking at this distribution here, I think the 25th percentile one is like really the most interesting one for people to think about. That's just like right, that's just historically, and you can make an argument that whatever, the world is different and technology could change everything, blah, blah. But, you have to sort of looking at this data set, say that's historically what it's based on. And so like, if you're making retirement plans, whatever it is, like, and you're doing an all stock portfolio, that's sort of the basis on which you're planning. And then I think that gets, as we'll get into future episodes, the next question is, instead of taking an all stock portfolio or taking that approach, what are some ways we could diversify that and add some other assets in? And what would that look like to try and, reduce that 25th percentile outcome effectively to create something more robust over time? So we can leave that as the teaser for the next episode.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.